But again, I think probably mid 2026 is when we're finally going to see that move start to really break out, right? I think we could probably get to 150, 170 before then, but I think by mid 2026 is when we're going to see the price start to skyrocket past 200, 300K. And because that is what the gold price, right, and the central bank easing plans are forecasting, is that's when the easing will actually happen. And if that's the case, then that's when Bitcoin will finally start to move, which is, again, a laggard to gold.
Welcome back, everyone. Today it's episode 40 of the Bitcoin as Store of Value podcast. We're recording on October 13th, right around block height 918,900. Today we're joined by a voice that it's become impossible to ignore in macro and Bitcoin circles, Roberto Rios, better known as Peruvian Bull. Roberto's story spans macroeconomics, market structure, monetary history, and Bitcoin. He first turned heads by digging into the mechanics behind the GME saga, then widened the lens with the dollar endgame, a project that connects debt, liquidity, and policy to the real-world assets people actually hold. On X, Substack, and YouTube, he built a reputation for calling out the fault lines, yen carry, funding stresses, and the push-pull between saving the currency and saving the system, and for explaining why Bitcoin and gold sit at the center of that debate. What sets Roberto apart is clarity under pressure. He has a talent for translating complex plumbing into plain English frameworks you can use. No hopium, no doom for doom's sake, just disciplined thinking and skin in the game conviction. Roberto, we're thrilled to have you on.
Hey, thanks for having me on. I'm excited to be here. There's a lot to talk about. It's been a busy couple weeks.
Yeah, for sure. So, and then as always, a warm welcome to our own Alessandro.
Hi, Johan. Thanks. Hi, Roberto. Very nice that you join as a guest, and looking forward for the conversation. Especially also, you are an expert on gold, and considering the brilliant performance 2025 for gold, will be great to discuss also about it.
Absolutely.
Yeah, it's insane. So, Roberto, maybe we can start with what happened last weekend. I mean, markets went crazy. Maybe you can share some of your insights. So what are some obvious takes you take away from this weekend? What do you think of the impact of such announcements? And what did you feel like? So maybe the audience can relate with how you went through the weekend, and where were you impacted by this? And does this whole thing that occurred makes you more or less bullish?
So I would say that, this weekend was pretty chaotic. Obviously, we had huge liquidations across basically every single major asset class. And when I was starting to dig into the actual data, I was wondering, what, for the first 10, 20 minutes as it was happening, I was trying to find out what was the catalyst. And then obviously we found that it was Trump's tweet, the threat to impose 100% tariffs on China, because China looks to be weaponizing their critical rare earth mineral reserves, which also forced the U.S. to do this deal this weekend. Another huge announcement, $20 billion swap line between Argentina and the U.S. Treasury. And a lot of the funds will be funneled into Argentinian pesos, which will ostensibly be used to invest in the lithium mines in Argentina. So basically securing U.S. access to critical rare earths. But this threat of 100% tariffs, blanket tariffs on China, obviously sent shockwaves throughout markets. If you look at USD JPY, which is the dollar yen carry trade, it collapsed from around 153 to mid 151 and even low 151 in the space of about 12 hours. Bitcoin and SPY both sold off hard. SPY was down like 3.5%. Bitcoin went all the way down 10%, almost to like 100,000, 101,000 at the very low tick. And I believe it was like $3 or $4 billion of leverage were liquidated in just a few hours during that, market chaos. And again, people were shocked, right? Like, why? First off, why did this tariff have such an impact on USD JPY, which is dollar yen? And then why did that carry over into basically every monetary or financial instrument that we know of, including Bitcoin and gold. And to me, the answer is pretty clear. It's something I've been working on for a couple of years now, which is, the yen carry trade, I guess, is emblematic of a broader problem in global macro. And that problem is markets have become increasingly dependent on liquidity. And the fundamentals, and you could say like economic growth and real corporate earnings, all these things have become more and more tangential factors to the core thesis, which is liquidity, right? Back in the mid 2000s, early 2000s, even 1990s, we would have bubbles, right? We'd have euphoria, but there would always be a fundamental underpinning under those bubbles, right? There's, stories of Cisco stock or Amazon stock starting to skyrocket in the 2000s. And obviously now we have the NVIDIA story, which is a giant liquidity trade. But there was always a repricing because the fundamentals wouldn't hold up to the narrative, and then that would cause the asset price to fall. But increasingly since 2008, and especially since 2020, markets have become increasingly dependent on liquidity. And a large part of that liquidity actually comes from Japan, because Japan has been the global funding arm of the global sovereign debt market. So for the last 20, 25 years, right, they've been the largest global sovereign buyer of bonds, both in the form of government bonds and corporate bonds. They've been the biggest buyer of U.S. Treasuries, the biggest foreign buyer of U.S. gilt, the biggest foreign buyer of French bonds, of German bunds. So they've essentially funded the global debt apparatus system we see today, because the rest of the world was at 1% or even 0%, and Japan's at negative, a negative interest rate on the short end, and at 0% interest rate all the way out to 10, 20 years. But in recent years, right, that story has been changing. And so that's caused USD JPY to blow out. And so I've now used this USD JPY exchange rate metric as a indicator of liquidity. And so whenever there's a liquidation event, right, the carry trade is unwound, which means the yen strengthens. So USD JPY falls. And then that means that all these leveraged traders are liquidated. So they have to sell other assets to get cash. So that means S&P 500, Bitcoin, altcoins, of course, those got absolutely destroyed this weekend, and even U.S. Treasuries, right? And so you just see this liquidation trade play out, and it's mainly driven, in my opinion, from this carry trade unwind that we saw play out this weekend.
Yeah, thank you. That's a great summary. And with this carry trade, because we saw this in August 2024. Then that was the real start of the unwind, I think, when the Bank of Japan, they did an unannounced rate hike, basically. And since then we saw the long end of the Japanese yields rising. What do you make of that?
So this is kind of the chaotic nature of the Bank of Japan's overall monetary policy, right? They're essentially flying by the seat of their pants, which for people who are not American or English natives, it just means they make it up as they go, right? For years they were stuck at 0% interest rates, and they were trying to stimulate growth. So they started to do things like negative interest rates, and obviously QE and QQE. They're actually the people who invented QE in March 2001. And then they said, well, we're not even getting enough, monetary stimulus to actually create economic growth or even inflation growth, CPI growth. So we're going to do yield curve control. And that didn't really work up until the late, 2019s or 2010s and early 2020s, when finally you started to see the Nikkei start to move from all the debasement they had done. And then we saw this what I would call a yen currency crisis emerge in 2022, when the Fed started hiking, because the Fed's interest rates started rising, massively above where the Bank of Japan was pinned, which was at the zero bound. And so all these carry traders saw this opportunity for free money. You just borrow in yen at zero or even negative, and you buy US dollars, and then you invest those US dollars into US Treasuries yielding 5%, or US equities that are up 10% a year, or even Bitcoin or crypto or gold or whatever. And so these carry traders started piling in, and USD JPY went from 110 in February 2022 to 150 by September. And then that precipitated the Bank of Japan to panic and say, wow, we need to do something. They started currency market interventions in mid-September of 2022, the first time they'd done so in about 25 years. And they followed that up with more and more currency interventions in October and December. And then in December, they decided to finally start moving the bands of yield curve control. And then, like you said, over the last few years, they've kept adjusting their policy, hiking rates, getting out of the negative bound. They finally paused yield curve control in March of 2024. And then in last August, they completely hiked, did an emergency, or you could call it a surprise rate hike, which shocked and scared markets, right? And they promised at that meeting, by the way, that they would continue to hike rates. But notably, they haven't hiked again since they hiked one more time in January 2025, but since then they have not hiked, and there's been several meetings. And so that tells you, like, they may claim that they can tighten more, they really can't. They have to let the yen blow out. But again, that means that these carry traders have just come back in force and said, okay, you're going to keep it 0.5. That's still pretty cheap. I'm going to still borrow yen, and I'm going to still invest this into US dollars, US equities, and, crypto and gold. And that's caused the yen to continue to blow out. We saw it go out to 153. And those traders also did the same trade on the bonds, right? Just like you mentioned, the 30-year and the 40-year bonds blew out from around 2.5% to the 30 years around 3.1, 3.2%, and the 40 years around 3.3, 3.4% as we speak right now in October. So a huge blowout of 130, 150 basis points. And this caused all these leveraged positions in the bond futures to be liquidated, which is causing losses on the books of Japanese banks. And so there are a couple of Japanese banks that are potentially in trouble, like Norinchukan, that Dario has been covering. But it remains to be seen, like, what the Bank of Japan is going to do, right? Because their hands are completely tied. This bond market blowout makes them want to do QE again, but then that will just spark inflation, which will cause USD JPY to blow out even more and make the carry traders even more money. And so that will cause more and more liquidity to leave Japan and to just flow into the global financial system. I think the conclusion that I came to is that they're trapped, just like every central bank. It's just that they're further down the curve, and that being trapped just means that they're going to be forced to add more liquidity to the system in the long run, which just means gold, Bitcoin go much, much higher from here.
Yeah, I think that's a great segue for Alessandro to pick it up here.
Yeah, thanks, Roberto, for the comment. And also, this will bring also more depreciation of the currency. So we will see maybe in Japan before what we will see in US later on.
Absolutely, yeah. And see, this is the problem, right? Like, think about, and I mean, Italy has this problem to a smaller extent, right? Other European countries too. Japan is a net food importer. They're a net energy importer. If their currency exchange rate blows out and goes way too high, it devalues too much, then the price of everything explodes in Japan. And we're already seeing CPI inflation in Japan over 3%, which is shocking, right? Like, the central bankers can't imagine all this money printing I did and all this like yen carry trade devaluation actually causes inflation. Yeah, it did. And now there's labor unions in Japan asking for wage increases for the first time in 30 years, right? Which is causing like massive upheaval, because in Japan this is like something they haven't seen in literally a generation or two. But yeah, it's a dangerous spot for Japan, because especially if you're importing energy and food, which are critical for your society to function, your currency blowing out is very dangerous.
Okay. And on the event on Friday, as Bitcoiners, we always say buy and hold, don't trade. So I think it was also a big lesson for all the traders. According to ChatGPT, I read that 30-40% of the traders put a stop loss between the current price and minus 20%. All the altcoins, maybe apart of few, they at least dropped 20%. So all these traders got liquidated. I think for them, after saying buy and hold, don't trade, maybe the only way they get that they should hold and Bitcoin is to get wrecked. And so it could be also beneficial for Bitcoin in the mid or long term. What do you think?
I agree. I mean, that was my thesis back in on Saturday and Sunday is, this, although people were so scared and disappointed about this wipeout, right, that it just cleared out so many leverage traders, it's a good move in the long run, because those people, if they're trading with leverage, right, they're not investors as you and I are. They're not in this for the long run. They're just trying to make money off the next 10%, 20% move in Bitcoin. They sell, they have, a take profits level, and then they get back in at a lower level. They're trying to play this game. And so those are what we call in markets weak hands, right? They just want to sell. They're just looking for some money, and then they get out and they're happy. With them getting liquidated, right, I just looked it up, $19 billion of leverage wiped out on Friday across all crypto, right? So Bitcoin, I think, was a couple billion, and then the rest of it was obviously even more leverage, which is why we saw, I'm sure you guys have seen this, but the Bitcoin dominance chart spiked up by a huge percentage. It was like 2 or 3% within the space of just a couple hours. Yeah, because what happened is, again, if you knock on Bitcoin for for traders using leverage, yes, there are traders who are wiped out, but all the other altcoins have even more leverage and no fundamental thesis behind them. And so they just got annihilated. I mean, SUI, I think, which is Raoul Paul's favorite coin, is down 90% or something, is completely rug pulled. ETH was down. Every single major crypto was selling off hard, even more than Bitcoin. And Bitcoin has rebounded, right, a bit. We still obviously need to push higher here, but all those weekends being gone from the market, I think, is a good thing for the long run. And what we want here is investors, not traders.
It's like a healthy cleanup, let's say.
Mm-hmm. It's a forest fire.
Yeah.
And I think it's also interesting, once one or two altcoins will outperform Bitcoin, casually the altcoiners, they will only highlight these two and forgetting the other maybe hundreds who didn't come up and they're still underperforming. So they were always interesting.
Exactly. Yeah, that's what the crypto traders love to do. They cherry pick the couple ones that outperform Bitcoin for a short period of time. There's a few months where it blows up and it does really well. Fartcoin was another one, another meme coin crypto that completely collapsed on Friday. I think it went down from 75 cents to 35, 37, something like that. So 50% loss in the day. And again, this is just because the only liquidity that's going into crypto is just the excess liquidity from all these carry trades and all these, you could say liquidity leverage trades that are being made from, easy central bank policy. And so when there are moves like Trump threatening tariffs, which would essentially, not freeze up, but would restrict the flow of capital globally, that scares all these traders. It forces them to get out of the carry trade. It forces them to, liquidate their leverage positions, which impacts crypto, which has, the altcoins especially the most, because they have the least fundamental thesis and they're the most based on just pure liquidity trades.
Yeah, thanks. Agree.
Of course.
Yeah. So, Roberto, I just want to get back to Japan again, because you have so much knowledge on the topic, but also because we've seen a new prime minister, the first female prime minister, I think, in the history of Japan. What do you think of her? What are the policies that she likely will pursue or roll out, and will that be more easing or austerity, or how do you think she's gonna play this?
So yeah, no, that was also a pretty recent development just in the last few weeks. Prime Minister Ishiba in August was basically pushed towards resigning. The LDP, which is the Liberal Democratic Party, one of the biggest and most staunchly entrenched political parties in Japan, lost quite a few seats in the upper house, which is a big deal for them, right? It's the equivalent of in the U.S. if the Republicans had majority in the House and Senate for 20 years and they've suddenly lost an election. That's essentially what happened this summer in Japan. And Ishiba has been, excoriated by the press and by the people for not only obviously his controversial immigration policy, but for USD JPY blowing out and for all this inflation. And the funny thing is, I always say, out of the frying pan into the fire, right? That if you try to solve, let's say, like economic growth problems by printing money, you just make more problems. And so Ishiba is being pushed out on this new prime minister. She's essentially decided to what we'd call in macro run it hot, right? Use fiscal dominance, use fiscal deficits to try to restart the sluggish Japanese economy. They've proposed cuts to the consumption tax. In Japan, you're taxed on usually food and beverage purchases, kind of like a sales tax that we have here. And they've proposed cutting that, which would eliminate 10 to 15% of government revenues and replace it with nothing, and just let it be. And so that combined with promises for more fiscal spending freaked out the bond markets in late September, early October, and caused the 30-year and 40-year yield to jump by 10, 15 basis points in the space of like a day or two. And so that caused even more pressure, obviously, on the yen, the currency itself, but also the bonds, because all these bonds are essentially trading in what I would call like a zombified bond market. They for 15 years, the Bank of Japan has run yield curve control, right? And also negative interest rate policy. And they've been what I would say call swallowing the bond market. They've been buying a ton of bonds. And this was starting even before yield curve control. This was with QE. And the net result of all this, the QQE, the QE, the QQE, the negative interest rate policy, the yield curve control, is that the Bank of Japan owns 55% of all outstanding Japanese government bonds. And they own around 80 to 90% of all the long bonds and over 100% of certain issuances. Yeah.
Whoa,
it's
that's
insane.
great.
It is insane. And Weston Nakamura reported in mid-August that the Japanese 10-year bond was not trading at all. Like it was, which it's happened before in November 2023 and December 2023, back when they were having severe liquidity issues in the bond market. But that's shocking, right? This is a country's 10-year bond, which usually should have a couple dozen banks trading it every day for liquidity purposes, for profit loss, for trading, whatever. And there's not a single trade that day. It doesn't go up, it doesn't go down. The volume says zero completely. So their bond market has been zombified. The banks don't want to trade these things. They don't want to own these things. The Bank of Japan is really the only buyer here. And so that means that whenever some macro event happens, these bonds move violently, right? Because there's no liquidity on either side. There's no one to catch a bid or an ask. Like it just moves there. And then finally someone steps in at 15. It moves 15 basis points in 5 minutes. And then someone says, okay, shit, I'll buy a little bit. I'll hope that the Bank of Japan will come in and rescue me from this trade. And so, yeah, that's just put more pressure on, obviously, the bond market, on the currency, because every tick up in every 100 basis points of yield increase on the Japanese bonds is equivalent to Japan paying for one U.S. Navy,
What? Wait. 100 basis points. So 1% point
is equivalent to, the U.S. to them basically paying for the entire U.S. naval fleet.
That's crazy.
Yeah. Because think about it. I know that sounds insane, but think about it. Japan's at 260% debt to GDP. They have the fourth largest economy in terms of GDP in the world. And so when you do the math, okay, so 260% debt to GDP means a 1% increase in interest expense as a percent of total debt is 2.6% of GDP. So if the average yield on the debt rises by 1%, right, total basis points, then that is equivalent to 2.6% of their GDP. And so if they, for example, if they normalize rates with the Fed right now at around 4%, they would pay 2.6 times that. So they'd pay 9% to 10% of their GDP in interest expense alone, right? Which is insane. That's almost the entire Japanese government budget, right? That's like 60% of it. So that's a huge amount of money. And so each 1% increase that they're doing, it's like they're paying for another entire U.S. naval fleet. And so people say that they can allow this to continue to blow out. I don't believe that's true at all. I think the Bank of Japan is just playing a game of chicken. And once things get bad enough, they'll have to do QE again. They'll have to do yield curve control. They'll bring all the rates back down to 0 or maybe 0.5 right? If they want to try to play this game of chicken a little longer. But in the end, they'll have to do more QE and they'll have to bring the yield down because it's just unsustainable.
That's crazy.
Yeah.
What are your thoughts, Alessandro?
I was not expecting such a big shift. That 1% is such a big impact. And now, considering that you talk about bond, I have now. So till last year, it was thought that Bitcoin firstly will take from gold, the market cap from gold. But we saw in the last 9 months, gold was plus 50%. And there is more and more knowledge that the dollar is devaluating. Also, Morgan Stanley highlighted the basement trade. So maybe more likely will be that Bitcoin and gold will go up together. Maybe Bitcoin more than gold, but also gold going up. And can it be that the bond market will be the first versus the gold market? Till 2 years ago, I think if you ask any Bitcoiners, they will say first we take from gold, it's the appetizer, and then there is the rest. But considering the current situation, the gold performance, can it be that the bond market will be first before gold?
Yeah. So okay, this is what I'll say. I've written a couple pieces on Bitcoin and gold because it's very interesting corollary, right? Bitcoin is what I would call digital gold, and gold is like the analog boomer trade version of it. And it seems to me that gold for the last several decades has been what you could call like a canary in a coal mine, right? It was the front runner to the debasement trade. So like if you look at gold's price action, I actually wrote a couple pieces about this. One was called The Printer's Coming. The other one is, I think, Gold is the Canary. And in both those articles, I outlined on my Substack how like in December 2018, gold started rising without a major Fed liquidity cycle, without any major macro news. It started bouncing off the lows that it had made that year. And started steadily increasing up into the 1700s, 1800s, and 1900s. And then obviously it started exploding throughout 2020 as the Fed began their debasement trade, right? As they began doing QE infinity, QE4, making a major move towards, liquidating, basically like, or monetizing all the assets in the world. And it peaked in August 2020, and then it started coming down. And everyone was shocked when that happened, right? I remember seeing Peter Schiff on TV freaking out, like, why is gold falling? The Fed's doing QE, like September 2020, October 2020, gold starts rising. And 18 months later, in March of 2022, right, we saw the Fed finally start their tightening cycle, right? They started hiking rates, they started tapering the balance sheet, and accelerated that taper in June of 2022. And so what had happened is that gold had front run the liquidity trade by around 18 months. And then it had also front run the taper by 18 months. And so it seems to me that like the major players in the gold market, right? The central banks, the bullion banks, they kind of have a finger on the pulse of monetary plumbing, and they know when the debasement is going to come. And so they front run whatever the Fed does. And so if the Fed is going to ease a lot more, they go and buy out a bunch of gold, they drive up the price, and then the Fed eases, and then they sell into that easing. And then when the Fed's going to taper, they start, cutting down their positions, which causes gold to correct for a period of time. And so this cycle, I see it as no different, right? Gold starts rising in February 2024, March 2024, and then really starts kicking off in January and February of this year. It goes even more. Yeah, this year has been much more aggressive. And so if we follow historical precedent and gold is the canary and Bitcoin follows, but with a bigger move, this means that, 18 months from beginning of this year, so that means mid 2026, the Fed is going to start a cutting cycle, and it's going to be a very big one because the move in the gold market is telling us that this round of easing is going to be even bigger than previous ones, right? Just as a percent. And that also means, beneficially for Bitcoin holders, that Bitcoin will move too. But remember, Bitcoin works on a lag to gold. Gold is moving first. It's moving more slowly. The gold bugs are freaking out over 50%, and Bitcoiners are getting so mad about this 50% move. But I have to remind you guys, like, 50% in Bitcoin is nothing. We've seen 200%, 400% moves, 1,000% in certain cycles. Like, yes, we can give the gold bugs their day. It's fun for them to make 50% in a year, but we've seen much more. And when Bitcoin will move, which it will move much more aggressively. And so I expect to see, Bitcoin rise to 300, 400K. So much, much higher than as a percent terms than gold will, just because it's a small market. But it will take time because gold is just closer to the money printer, and it's closer to the central bank balance sheet than Bitcoin is. So it'll just take more time for the liquidity to flow, but it will.
Also, yes, and also because the understanding of gold, it's much more higher. The general understanding what gold is versus what people understand what gold is versus Bitcoin. We see that now it's moving with liquidity market because most of the people, they treat Bitcoin as a tech stock, as a risky asset. And there's also poor understanding of the general population on Bitcoin makes also that it takes time to understand that if something goes bad in the society, in the economy, Bitcoin should be a reserve asset, and it's still not. Also.
Yeah, absolutely. There's just a complete lack of understanding of what Bitcoin is, even on Twitter. Still, I mean, I'm sure you guys get into this where people just do not understand Bitcoin at all, are in the comments and in the replies mocking and degrading, Bitcoiners. But truly, like the problem is the majority of financial institutions today are being run by boomers and Gen Xers, right? And so these are people who grew up with the Fed is always right, bond prices always rise, stock markets always rise, gold is always the hedge. And so their default is to just plow into gold as the first move in their debasement trade, right? But increasingly, I mean, I think we saw it was either Morgan Stanley or B of A, Merrill, that said that a strategic allocation to Bitcoin of 4 to 5% was recommended for all of their signature wealth clients. And so that's a pretty big move, right? That institutional TradFi is finally starting to see the merits of Bitcoin, but it's just going to take more time because these people are older. They're going to be the laggards in adoption, but that's good for retail because we should be the first ones anyway.
Yeah,
definitely.
We like to say Lagarde, Christine Lagarde instead of Lagarde. So I wanna keep. Sorry, Alessandro, you first.
Okay, and I want to say yes, it's good for retails, but on the other side, it looks like retails are sleeping. It's the quietest all-time high. We are having the quietest all-time high in this year. It also, for me, it feels that we need institutions buying aggressively to 150, 200K. And then those who are not yet in Bitcoin will come back. There are those who are already in Bitcoin, they are maybe increasing their allocation, even more convinced. But the retailers who are not in Bitcoin, they deserve a higher price, let's say. They deserve only Bitcoin at higher price, not now.
Yeah. Now, and I think we're still in this consolidation phase, right? Like you said, we have to get the leverage in Bitcoin wiped out. We have to get more institutional adoption, more consistent buying pressure. And until then, we're kind of in this holding pattern between 100 and 125K. But for gold, right, the fundamental story there is central bank demand. In August, Poland added 5 tons. India bought more. The Bank of China, the People's Bank of China, has been buying gold basically every year for the last 10 years on net. And I'm sure you all saw this chart from Tavi Costa, which was a very big, shocking chart. As a whole, foreign ownership of gold in August of this year eclipsed treasuries for the first time in like 23 years. And so that means that central banks globally are seeing gold as a better hedge or as a better store of value than U.S. treasuries, which makes sense because of the Fed's hiking cycle, which obviously hurts the bond prices. And so that allocation just means all this money right now is flowing into gold. All this money is flowing into precious metals, which is causing the price to continually and steadily kind of just like grind upwards, up and to the right, as we near the next major Fed easing cycle. And again, a large part of the demand is coming from Asia. You look at Shanghai, they have a precious metals exchange there, the Shanghai Gold Exchange, and it's the largest physically settled exchange in the world. Part of the problem with Eastern and Western markets is that especially in the West, most Western markets are what's called cash settled. So in commodity terms, this means you buy a futures contract. Let's say it expires December 2026, And when the futures contract comes for delivery, right, and it's profitable, the hedge fund or the high net worth investor or the bank or the trading brokerage, like whoever's doing the trade, can choose to either settle in cash or settle in physical, which means take the actual delivery of the gold, get it delivered to your, to a vault, get it delivered to a farm or a ranch or wherever you want to store it. And the problem is, in the West, for the last 30, 40, 50 years, it's been mainly cash settled. So 97% of trades on the COMEX are cash settled, which means the other participant just says, okay, instead of giving you $4,000 worth of gold, we'll just give you $4,000 in cash. And then you can just roll it forward into the next contract. And so that's created this paper market, which is leveraged against real gold, which allows them to sell all these gold paper claims, right? And not actually deliver the underlying, not actually give up the real gold. But what's happened in Shanghai in the last 4 or 5 years has really changed things, because the Shanghai market is only physically settled. So you have to take delivery, which means if the Shanghai price rises, especially the difference between Shanghai and COMEX or LBMA rises too much, traders come in, they say, hey, I can buy the cheaper Western gold, take delivery, and ship it to Shanghai and sell it there for 50 or 70 bucks more an ounce. And that's exactly what started happening in 2023 and 2024 is the Shanghai gold price was rising well above Western. Traders were going and buying Western gold contracts and actually taking delivery, which, again, the exchanges were not ready for this. They were thinking, oh, no one never takes delivery. We don't need that much gold, blah, blah, blah. And then suddenly all these people start taking delivery and shipping it over to Shanghai, to China, and draining the gold from the COMEX in 2023, 2024, which caused the COMEX and the LBMA, as I'm sure you might have remembered, the LBMA was having a crisis in February of 2024 or 2025 of this year. So the gold market was completely starting to break, and that's again what we're seeing. There's more deliveries of physical right now to Shanghai than at any other time in history. And the Chinese and the Indians, especially, and the Japanese too, are snapping up as much gold as they can. And again, I think it's because of their own problems with their own economy. But that rush into gold is now causing this cascade of higher gold prices throughout the world because they're drawing in so much gold.
Yeah. Thanks. Interesting to know these details behind what's happening in gold.
Yeah,
of course.
So I even heard that in Europe, like there needed to be gold bars, but they were all they 12.5 kilograms, and they were sold in different kinds of amounts. So they first need to go to Switzerland to like molten down, and then like sliced up in different how do you say that, like weights or different bars, and then
sizings,
sizing, yes. So that's so I'm writing an article right now about gold, and what also struck me that is the at current prices. So I want your take on what you think is sustainable for gold, but at current prices, if gold has an inflation rate of between 1.5% and 2%, then like even if all the gold bugs are holding their gold, so nobody's selling, then we have 480 billion dollars of supply growth, so inflation. So they need at least 480 billion dollars of new demand for the price preventing from declining, basically. So what do you think? Where could gold go to? Is it over? Is it stretched out? I don't know.
Yeah, so that's a good way to put it, right? And this is again the key difference between gold and Bitcoin, right? Like, Bitcoin is basically like the hardest money that's ever existed, right? That's been ever created. And so we don't really have, especially now this late in the mining cycle, right? Where we're only have a couple, 1 million coins left total to mine, like just a few percent of overall supply. The supply or the inflation rate of Bitcoin is much, much lower in the long run than gold, because gold has a permanent 2% supply growth every single year. But what I would say is that, especially for the short term and immediate term, the growth in liquidity will eclipse and overcome the lack of demand, or that $480 billion shortfall. So all we need is another $480 billion to be printed somewhere in the world that has access to gold markets, and for those investors to buy gold, for that shortfall to be overcome. And overall, like I mentioned with the paper gold trade, gold is still undervalued, especially in fiat terms, right? If you try to back, for example, there's a couple different studies done. You look at historical backing of M2 money supply with gold in the US, and historically it's around 40%, which means that the total US gold holdings should be worth around $8 trillion, which would imply a $30,000 gold price, right? So much, much higher than it is now. Same thing if you look at gold backing in comparison to US debt load. Gold backing as a percent of US debt load was like 15-17% historically, and that would imply a $28,000 gold price, right? Around a little less than $8 trillion of total gold value of gold held by the US. And right now the US holds about $1 trillion worth of gold. So by either of those metrics, right, gold is very undervalued. Gold should be going up, 5x, 7x, 8x maybe, if it was to recalibrate to historical levels. Now the question is, will it ever really recalibrate to historical levels? And that's where I'm not so sold, because the gold bugs will claim that that's going to happen, but I think us going back to a gold standard is just unrealistic and unfeasible, especially in a modern digital economy, right? If you want to go pay for microtransactions, which is the majority of your daily transactions, right? You don't spend $1,000 or $2,000 every single day. You spend $5 or €5 or €2. You buy a soda, you buy a drink, you buy some food, you buy a coffee. No one wants to walk around with a gold bar and shave off a couple flakes of gold and weigh it on a scale and look, oh, okay, I have, 2/10 of a gram, 3/10 of a gram. Okay, that's 3/10. That'll pay for my coffee. We're not going to go back to that, to that kind of a monetary system. So again, I think gold is just the first canary in the coal mine of people getting worried of monetary debasement. It's a good sign, but the move is coming for Bitcoin. It's going to come in larger size. And I think Bitcoin is the only, hard money that actually has the ability to replace fiat as a monetary system, right? I just don't think gold can get us there. And gold will only get us, even if gold is adopted as a monetary instrument, it's going to still be intermediated by fiat. So it won't fundamentally solve this problem. Maybe they'll reset us to 20% gold backing, but then in another 20, 30 years, they're going to start debasing again. So we'll just be back in the same cycle every single time. And I think, as the monetary system evolves, right, we don't want to go back and repeat the mistakes of the past. So we're not going to go back and remake a gold standard. We should go forward and make a Bitcoin standard and move towards a better future in that sense. So it's just a canary in the coal mine. But yes, I believe gold has significant upside, right? Goldman Sachs raised their price target to $4,900. I think $5,000 by Q1 2025 is not unrealistic. But long run, I see gold, doubling or tripling in the next few years. I see Bitcoin, vastly outperforming that. So 5xing, 6xing. Yeah.
All right. That's why they call you the Peruvian Bull, right?
Yeah, exactly.
So what also struck me is that in the last 1.5 years, I think the gold, the market cap of gold grew $14 trillion. And for people, that's almost 7 times the entire Bitcoin network. These are crazy amounts. I mean, it's
it's huge.
Yeah, it's huge. Yeah.
Just a few seconds to remind to our listeners that this podcast is sponsored by Bitvault, bitvault.sv. I invite you to head over to the site. It's the first Bitcoin wallet solution to solve the problems of physical attacks and hacks, thanks to our time delay over multi-sig technology. The beta is for free, coming out in October. I invite you to head over to the site and leave your email to get notified. Thank you very much.
Alessandro, do you have another question for Roberto?
Yes, considering you said also, you call also Peruvian Bull, you said Bitcoin will outperform 5 or 6s, and also I agree with this. And you said Bitcoin is lagging gold, as we saw in the previous years. This will be against the fact of the 4-year cycle. According to the cycle, we had December 2017, November 2021, so October 2025. And the last cycle, we saw a minus 60, minus 80% in less than 12 months from the all-time high. How do you think this institutionalization and financialization of Bitcoin is having an impact for the next 1 or 2 years?
Yeah, that's a very good question. And that's actually been the top of mind of a lot of crypto analysts, or Bitcoin analysts, I should say. Not really crypto doesn't really have analysts, right? They just have meme coin pumpers. No, but a lot of Bitcoin analysts have been kind of commenting on this, and I think an interesting thing that they've said is that this cycle is going to look much different than any other, which I agree with. Right? We've seen, like you said, progressively as Bitcoin has matured as a monetary instrument and as an asset class, the drawdowns have become less and less severe. But this cycle, I think, is going to be even more pronounced. That the drawdown is going to be much less than people expect. So I think 30%, 40% drawdown maximum at the bottom of this cycle is probably the limit of what we're going to get to. And that's just because the institutional story is now getting so strong, right? That the ETF story, right? The ETF inflows, IBIT was the most successful ETF in the history of the world. It outpaced in 30 days. IBIT had, after launch in January 2024, had more inflows than GLD, the largest gold ETF, had in like 7 years. And so clearly there's a huge demand story here for Bitcoin. But the problem with the institutional markets is, right, they're slow, they're plotting. They more represent like the methodical weekend, quarter end, year end buyers that are like slowly DCAing in, and not retail traders pushing price up 80% in a week like that we used to see in previous cycles, right? And so that just means that the market's going to become more and more dampened, less and less volatile. But obviously the drawdowns are going to get lower and lower. And so I do expect obviously some sell-off here. And then I think the cycle theory is not completely dead. But I think as we move forward into especially the next few cycles, it's going to just dampen out more and more. And we're just going to see this smooth slope of the Bitcoin price just slowly and steadily rising. But again, I think probably mid 2026 is when we're finally going to see that move start to really break out, right? I think we could probably get to 150, 170 before then, but I think by mid 2026 is when we're going to see the price start to skyrocket past 200, 300K. And because that is what the gold price, right, and the central bank easing plans are forecasting, is that's when the easing will actually happen. And if that's the case, then that's when Bitcoin will finally start to move, which is, again, a laggard to gold.
Okay. Yeah, I think as well it will be delayed, and probably for the next few months it will be, Bitcoin will keep borrowing us and going up. Maybe we will be boring. Most of the days is boring, and then we go up, then a bit lower. And also, but at one point, I also agree. I think there will be a kind of a new bull run, because once the world agrees that 2, 4, 6% allocation in Bitcoin is recommended in a normal traditional portfolio, and now Morgan Stanley started to say, BlackRock is saying, when the world agrees, there is probably 95 or at least 97% of the portfolio have no Bitcoin allocation. If they all move 4% on Bitcoin, there should be a bull run. The halving will be less. Now it's 0.8% per year, and the future will be 0.4% increase in flow. So
Exactly. And so that, again, think about it this way, right? Bitcoin is Bitcoin's total market cap is 1/7, like he said. It's 2 trillion. Gold in the last few years has increased by 14 trillion. 1/7 of just the net increase in the gold market cap in just the last few years. So once the institutions really finally getting their head around and they start allocating a significant portion of their, you know, of their whole overall portfolios into Bitcoin, like 10%, you can see Bitcoin skyrocket. Right. I mean, global M2 is north of 200 trillion. Global bond markets are $400 trillion. Overall global commodities, real estate, and everything combined is like 600-700 trillion, and gold and Bitcoin's too. Like the idea that we're going to stay here in this range bound area forever is ludicrous, right? And I think also the other thing that Bitcoiners have to remember is, you should be happy about low Bitcoin prices or like flat Bitcoin prices, right? This is your time to stack. I truly don't. I kind of joke around with people, especially on Nostr and Twitter as well, when they all panic whenever there's a sell off, right? Oh my God, Bitcoin's at 108,000. And I just tweet out like, "Oh no, my favorite asset is on sale. Oh no, I'm so sad. This is so bad." I'm like, guys, come on. You guys are all saying you're long-term investors here. Shouldn't you be happy at 108,000? That's cheaper than 120. Oh no, it's going to stay here for another few months. Okay, great. That's a few more months of income I can pour into Bitcoin. This is a net positive for us, right? If you could teleport any of us back 10 years and told us Bitcoin is 2,000 or 1,000, and you have a whole year to stack Bitcoin, I would have been ecstatic. And so I see this as no different. So this is a good thing for us that the institutions are only barely beginning to catch on. And a lot of the institutions are even just they're also holding paper Bitcoin. They're not even holding real Bitcoin. And so especially once institutional custody, like hands-on first party, not third party custody, comes commonplace, we'll see much more physical like withdrawal of Bitcoin right from the exchanges, from Coinbase, from the custodians, and actually held by the actual institutions on their balance sheet, which will be exciting because that will ensure that we can't be doing these paper games of IOUs, just like what happened with gold, right?
Okay. Yeah. Thanks.
Yeah.
So I just wanted to go back to you said that that the central banks, they own more gold than U.S. treasuries, right?
Yeah.
What was that? Yeah. Like the other, I think, is it also because after the Russia-Ukraine war that the U.S. really used the dollar and the treasuries as a weapon, and they seized and they freezed accounts from the Russian government. So, because I'm also thinking in terms of, are people valuing gold more because of the characteristics of gold, or is the dollar devaluing, or is it both? And also I'm trying to think through when Bitcoin rises, is it just the dollar devaluating, or is it really the adoption of Bitcoin?
Yeah, that's a very good point, right? That's something I've been thinking about for quite a few years now. In 2023, in February, I put out a thread called "The Dollar as Excalibur: The Treasury's Secret Weapon," and essentially, the thread was detailing how the U.S. government was, you could say, like militarizing or weaponizing the U.S. dollar as an instrument of foreign diplomacy, right? And so obviously, like what you mentioned, during the Russia Ukraine conflict in February of 2022, the U.S. government and the Treasury, under their office called OFAC, Office of Foreign Assets Control, seized billions and billions of dollars of Russian-owned U.S. treasuries, U.S. equities, gold reserves that were still held in Europe and in the U.S. And that caused shockwaves throughout the global financial system, because now suddenly all these foreign central banks realized, and all these foreign politicians and prime ministers realized, that any gold or any U.S. treasuries they hold or any U.S. equities they hold are only held as long as they are in the good graces of the U.S. government, of Uncle Sam. And once that changes, they can seize your assets. They can seize your gold if the gold is held in the U.S., and they can seize your bonds. And so your assets aren't truly yours, right? We live in this custodial system. And so that means that, not only is there obviously a debasement play here of, oh, there's going to be money printing, there's going to be more inflation, we need to buy gold to hedge. But there's a sovereignty aspect as well. There's this worry, concern that's been increasing, especially among, you could call it the antagonists of the West, right? The countries that are portrayed as the villains, the China, the Irans, the Russias. There's been this perception that they need to buy and hoard more and more, like you could call bearer assets, right? And so that's meant that Russia and China have been most aggressive in buying gold, and so that's caused them to be very aggressive in doing the price. But I'm giving a caveat here in terms of gold and Bitcoin. The reason why they aren't so interested in Bitcoin as a nation state is because the problem with Bitcoin is that it's too good at what it does. So Bitcoin completely obviates, right, the need for the state. It completely goes around that. You don't need a central government. You don't need a central bank. You don't need commercial banks to administer this monetary system. And that's scary for monetary elites, right? If you're Vladimir Putin, if you're Xi Jinping, you want to have control of your monetary system because it's a way that you can control the people. You can control the political system, the social system. And so giving up that control and just free on or full on adopting Bitcoin is too terrifying. And so gold is like the middle ground that they can get to of like, we're going to get some store of value. We're going to get some monetary debasement hedge. We're going to get some sovereignty, but we're not going to go all the way towards like giving the people full sovereignty. We don't want to go that far. So, I think that's one of the unfortunate roadblocks in the way of Bitcoin that most Bitcoiners don't realize. And I do believe it will be overcome because I think we talked about this on Twitter. My overall thesis and the final stage of dollar endgame is, I believe, all nations being forced to Bitcoinize, to adopt Bitcoin as a monetary medium for global trade, as a reserve asset, and for using it to exchange value between borders, right? And no more fiat sending payments and all these problems. No more gold. We don't want to send sailing ships of gold from France to England to the Netherlands to Japan to Thailand.
Switzerland,
like, it's just too
resize.
What?
To Switzerland to resize.
Yeah.
In the meantime, yeah.
Exactly.
Yeah.
We don't want to be doing this game. This isn't the 1800s, right?
Yes.
But the problem is, again, that happens later in the game when the central banks and the monetary authorities are forced to, because the whole world fiat system is collapsing and there's no other option. Everyone is getting into Bitcoin and they're dragged there kicking and screaming, right? They don't want to be in a world with Bitcoin because that world, it means they have no power and suddenly all their free money is gone. So that's going to be the very end stages. But this is a good signpost to me that this is an intermediary stage. Getting into gold is the first step. And, as the US and as other nation states potentially pursue Bitcoin accumulation strategies, we'll see this end game, this game theory start to play out between nation states of who can start buying Bitcoin and adopting it as a neutral reserve currency.
Yeah, that's such a great point. We're already approaching 1 hour. So, Alessandro, do you have a last question for Roberto?
One last question on Bitcoin skeptics. We are now in 2025. We see that the skepticism evolved. Before it was more not used by only used by criminals, nothing, no value, and so on. It evolves, but we are still have so many people saying has no intrinsic value or is a bubble. I'm a bit disappointed. I understand Bitcoin is hard. I always say you have to study a lot of hours, hundreds of hours before properly understand Bitcoin. But still, in 2025, I understand, okay, still volatile, could be volatile, we have seen on Friday. That can scare people. Or you can say, use energy consumption. We know that is false, but if you didn't study, it's okay. But still, many, they are saying he has no value and is reached 2.4 trillion. And again, it is a bubble. After 16 years, it's a 16 years bubble. It's the biggest bubble ever in the world. Like there are still this kind of skepticism. Is also disappointing you that we have still to fight this skepticism, this level of skepticism?
Yeah, it's disappointing, right? But it just shows a fundamental misunderstanding. And again, you have to remember, right? These people, and by the way, I went to university for economics and finance, right? I took all those classes. I read all the books. I read John Maynard Keynes. I took modern monetary theory classes and modern banking classes. And so I know that these theories of, fiat being the end all be all of financial systems, and Bitcoin and gold, especially Bitcoin being a complete farce and a lie, has been pounded into the heads of every economics and finance student across the West, everywhere. There's not a single university that teaches pure Austrianism and just decries Keynesianism as a bad, thesis. And so we're not only fighting, obviously, just institutional resistance of like, I don't know what this thing is, this is weird. We're also fighting decades of propaganda that have been put into the heads of asset managers, bankers, economists, academics, politicians, etc., and even the voter base itself, right? But the key thing to remember, and this is the thing that I actually probably should make a Twitter thread about this, is that intrinsic value does exist. And it doesn't exist in the way that people think. The way that intrinsic value exists is through utility value. So the way I describe to people when I get into arguments on Twitter is I say, okay, I'll tell you the difference between intrinsic and extrinsic value. Let's say you're on a desert island. Let's say there's no food and no water. Let's say you find a bottle of water and you find a painting. The bottle of water has intrinsic value for you because it has utility. What's the utility? You drink it and you don't die of dehydration. The painting of a dog is a cool painting. Nice. I like it. And maybe if I had a friend here who really loves dogs, he would give that painting a little more value than I would. But that's a subjective view. And my view of the water is objective. Why? Because I need it to survive. That's utility. Okay. Bitcoin has utility value. Bitcoin is used for something. Bitcoin is a monetary medium. A monetary medium is needed in order to sustain a modern economy. Unless we want to go back to sticks and stones and barter, and I grow 5 sheep and you grow 2 cows, and we trade the cows for 5 sheep for 2 cows and plus 1 chicken and half an egg. Like, unless we want to go back to that system of the Middle Ages, we need to be using a modern monetary medium, and a digital one at that. And so therefore, Bitcoin has utility value. And if Bitcoin has utility value, then it has intrinsic value. And that intrinsic value is needed for the survival and the growth of civilization, right? That's a necessity. And so that can't be debated. And again, there will be obviously subjective value that some people place on certain things. Some people will price Bitcoin, I would say all Bitcoin buyers, right? If you're buying Bitcoin at these prices, your subjective value of Bitcoin is more than 110,000. Because if it wasn't, you'd be selling. So you don't realize it, but if you're buying Bitcoin right now, your subjective value is maybe 200, maybe 400, maybe millions, right? My subjective value is infinity because I believe that there's, just like Bitcoin has no top, fiat has no bottom. And so I will buy at any price. I don't care. If it's cheaper, I'll buy more. If it's more expensive, I'll buy a little less. I'll wait for a dip. Like that's my philosophy. And so again, because Bitcoin has this utility value, because it's actually used for something, it actually has real intrinsic value, which means it's objective, which means you should buy it if you want to survive this next monetary reset, this next wave of debasement. And again, the same is true for gold. Gold does have intrinsic value. Gold is resistant to rust. Gold only inflates at 2% a year. Gold has industrial applications in dentistry, in hardware, in space, and mining, right? There's actual use cases for gold and silver and food, right? All these Bitcoin skeptics would never dare to say that oil has no value or copper has no value or a house has no value. Oh, yeah, that house, okay, maybe I can use it to sleep in, but actually that's all value is made up. It's all utility, it's all extrinsic, it's all subjective. Okay, great. If it's all subjective, then give me your house. If it's just a matter of opinion, just change your opinion about your house and don't sleep in a house, sleep on the ground. What's wrong with that? Oh no, well, I have to keep my house. Come on, man. That's crazy. And then I say, okay, take your same logic of utility of why you would use something and apply it to Bitcoin. Why do you need Bitcoin? Because you need a monetary medium, and Bitcoin is the best monetary medium that's ever been invented in the digital age, right? It's perfectly made for a hard money and a medium of exchange, for the world to not have to trust central bankers anymore. It's literally the immaculate conception. There's no other currency that comes close to Bitcoin in terms of its utility value and its hardness in terms of sound money. So there's Bitcoin's value for you. If you're a skeptic out there, read about Bitcoin, learn, listen to podcasts. What I'll say too is I was a Bitcoin skeptic as well. Once I was a gold bug, and I was just like, oh, I'm 30%, 40% of the way there, but I don't understand this. I don't understand that. The transactions per second is too low. What about, oh my God, what about the up return? What about the block size wars? What's going to happen? Like blah, blah, blah. And the further I got into Bitcoin, I realized that every objection that you have to Bitcoin has already been answered. Every question you have, somebody already wrote an article about it. Every time you say, oh no, but hey, the difficulty adjustment, how does that help anything? Oh, actually, no, here's how it works. Oh, well, we'll run out of coins to mine. The whole network will collapse in 10 years. Oh, well, the blocks will be filled with transaction fees, and transaction fees will go up a little bit to compensate. Oh, well, oh my gosh, what happens if there's a solar flare and half the world's network is wiped out? Well, we have nodes in space, so the Bitcoin network will stay running, and we have miners in Antarctica, so it'll stay running. The only event literally that could wipe out Bitcoin, which I've also joked about with people on Twitter, is like a nuclear holocaust and then a meteor and then like the sun exploding. Like, okay, fine. They're like, what if there's a nuclear holocaust and then the moon splits in half and the moon hits the earth and then all the dinosaurs come back and start eating people and then there's a virus and everyone's dead? What's your Bitcoin worth to you then? I'm like, okay, yeah, the Bitcoin is worth nothing then, but we're all dead. So I think that's a good trade. Like your gold will be worth nothing too. Your stocks will be worth nothing too. Come on, you guys. It's so stupid. So
and we will have other problems to face.
Yes. If there is a global EMP and a catastrophic meteor shower and there's essentially 50 nuclear bombs going across the world, I will be worried about more things than my Bitcoin holdings in my cold wallet. Like I will be worried about living to the next day. That's what I'll be worried about.
Yeah.
Good. Thanks. Good way to put it about the Bitcoin skepticism.
Yeah, of course.
Okay, so Roberto, where can people find you and where can they read your work?
Absolutely. So I have a Twitter, which is at Peruvian_Bull, or if you just look up Roberto Rios, I'm the only verified account on there. So if there's a lot of other spam accounts, so don't follow those, just the one with the blue check mark. I also have a Substack, which is called $endgame.substack.com. And there I write about Bitcoin, I write about gold, I write about monetary plumbing, I write about macro. And so if you're interested in that, please, sign up and support me there. And then I also have a YouTube channel, which is Peruvian Bull. And so if you just look up Peruvian Bull, Bull, on Twitter or on YouTube, you'll find my channel as well.
All right. And your book, because you wrote a book?
Yeah, the book is called $Endgame, and that book is available on Amazon if you want to purchase it. I also have free versions online. If you just want the PDF, I never want to be a person gatekeeping information and the ideas. So if you look up $Endgame PDF or you just look up $Endgame on Medium, you can find the whole series on medium.com. It's split into 7 parts. So each part is like a 20 or 30 minute read. And then it's also on Reddit, and there's also a Google Docs somewhere floating around that's like a free, Google Docs version that I still keep up. So yeah, you can read it for free if you want, or if you want to support me, you can buy the book on Amazon for like $30.
That's great. So thank you for very much for this great conversation. I really enjoyed it. I really learned a lot. So thank you.
Of course. Thanks for having me, you guys. This was a blast.
Same from me. Thanks, Roberto. It was great to have you as a guest.
Thank you. Great meeting you guys.
All right. We'll hope to meet you someday here in Europe, or we'll come to the States.
Absolutely. I've got to make a trip out there. Like we were talking before the show, I've never been to Europe. I've never even traveled to that side of the world. So I will be making it out there at some point. I guarantee you. I've been to a couple of Bitcoin conferences. I spoke at the last 2, and I spoke at Adopting Bitcoin. So I will be, hopefully going to Prague at some time in the future.
All right.
We'll see. I'll let you guys know.
That's a deal. Bye, guys. Bye.
Bye-bye.
Bye-bye.